Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Good morning.
Hello, everyone. Welcome to Friday. Sorry we're a little bit late. A little bit of a technical snag. Michelle's device wouldn't cooperate with the internet for a few minutes there, but we're here now. Glad to have you here with us on a Friday. And we're again in the spare bedroom in Oklahoma, and where we hosted a V8 meeting last night, which is really what prompted our subject for today. And this is important, Michelle. I don't know that you got to read the description for the event, but it's we're taking on some pretty important stuff, and I would just tell folks who are tuning in, we want you to be part of this ongoing conversation at V8 Group. Like we are digging into some really great stuff. We're going to give you some highlights here today of what we covered for the second time yesterday, and the conversation continues, and I think it's an important one, and it's one of many. Obviously, there are many threads that we're working through in our V8 format, but encourage you to jump over there and join this conversation. It's really it's the big stuff. It's the stuff that we just don't find enough time to talk about in our business. And so I encourage people to get involved in our V8 groups and join those virtual conversations. Yeah. Let's keep it going.
Yeah, Jim and I have had multiple conversations around this topic, and sometimes he's like, "Save that." Let's ask those kind of questions. And then there's other times that Jim's like, yeah, don't say that. Okay. Because sometimes I'll ask, or
she sometimes gets a little assertive, we'll say.
Yeah. Well,
and it's like, well, there's more to think about maybe than just that. So that's kind of what she's referring to. But this is, again, an important conversation. What I've done is I created a tool that we first introduced it on the podcast. It's probably been a year and a half or so ago, around this idea of when to trade. What does it look like to trade? And so this was when this conversation came up in our V8 track about writing a policy, which that's what we're doing basically, is working toward creating a policy template for dealers to use in trade-ins for internal trade situations. Because it happens a lot. Customers want to trade, and when does it make sense? And you get lots of different opinions. And obviously in our work at White Hat Way, we're working to move beyond opinions. We want hard math to really be able to lean on where it's available. And certainly there's some parts of this that are still business model related, but I think for today, I would encourage everybody to look at this information we're going to present today as though we're not going to present anything really that's open for debate. This is just math. You can pause the screen and double check calculations, but the reality is what we're working with is just some simple math that is based on everyday amortizations. And what it shows is pretty revealing. I think it's something that, listen, and we wouldn't be the first to know this. It's like, there are analysts out there with the various lenders and these folks who probably behind the scenes are studying this kind of thing already. It's just that for us, it's the first time we've had our own tool to be able to really walk through it side by side and compare, one scenario over another.
Yeah. And those that watch frequently, we usually have two viewpoints on tracks on a lot of different things. There's the straight lines and there's the squiggly lines. A lot of this that we're going to talk about is very, very straight lined, and there is a really rich conversation around this topic with squiggly lines. Sure. There's a really, really rich conversation around this, around connecting with your customer and keeping customers sticky. Yeah. And so, because, I don't think that we need to bring math to the conversation to say, if you can keep a customer, how much more money, and how much less money. I mean, how much more money you make, how much less money you have to spend to keep your portfolio at a certain level. Because, we know what the costs are for acquiring a customer. There's a lot of marketing costs. There's a lot, and that is a straight line thing in this conversation as well that we're not going to talk about today. But the idea of having customers for life, this idea of the repeat and connected and having, communication and all of that. This is something that when we look at this model of trading in 24 months, that also requires a level of communication as well. And so, for you as a dealer to have a customer want to do that, not only do the numbers need to look good for the customer, but they need to have a good experience.
Right. So to the number side of this, let me kind of explain before we start showing the tool what it is that we've created. So we just took a simple, typical kind of an amortization tool. I basically built an amortization tool that forecasts contract length or an amortization based on the assumptions that you load in there. And then I chose 24 months to be able to illustrate. We just picked 24 months, and we talk a lot about the 24-month window in our V8 group, just to kind of keep it consistent in different conversations. We like to talk about the 24-month sort of interval. And now, as we get into this information, the one caveat I want to throw in there before we get there is I didn't get an opportunity since our meeting last night to put out there again the question of calculations on profit and loss, because what the tool you're going to see takes the position at 24 months, and if we traded the customer at 24 months as an example in this illustration, then what is the impact to the bank accounts? What's the impact to the balance sheet, the actual assets? And then what's the impact to the profit and loss? And there's still some debate about the calculation on the profit and loss. I'll show you what we have in there now, but just don't get too hung up on those numbers, because we want to validate and verify before this thing is released. And we
already have had conversations, or Jim's had conversations with numerous entities, people on this about where these numbers need to fall.
Let's go ahead and share it, Michelle, if you want to get it on the screen for us. I've got it teed up here, and let me just kind of show folks a little bit about the structure.
We're going to need to enlarge that.
Let's see what I can do without losing everything. All right, so hopefully you can see that a little bit better. So a couple things, you can see these fields in yellow are generally our input fields. Those are manual input. You can plug in the numbers, and I've got an actual dealer, one of our V8 members, I've got their data loaded in here as an illustration. And then what that does is it drives this amortization that you see up here in this section. I don't know if folks can see my cursor on the screen there on their side, but this is built-in amortization. Right here, though, I need to show one more row. This jumps from payment number 1 to payment number 48. I'm using a biweekly interval. It's just easier math and an amortization for us. And so I'm using and biweekly payments are common, obviously, in buy here, pay here space. So this projects out an amortization on a biweekly payment. We've used a payment of $650, which is the dealer's actual average over the last 6 months. All of these numbers that you see in this deal structure are our dealer's actual averages from the last 6 months. And so that builds this projection. And now we jump out here to the 24-month mark. All right, so let's go slow on this, because I think, and by the way, Michelle, I'm going to share this tool with our V8 members. Once we get that P&L part, our V8 members are going to have this as a tool they can use at the time of working a trade to kind of help a snapshot look at those elements that we're going to cover. But if you have a vehicle that started out with a cash value over here, or a wholesale cost of about $11,000 in this dealer's case, we left it for a fill-in-the-blank number here to say, what do we think that car would be worth as a trade-in, cash value, actual cash value at the 24-month mark? And so this is where we just plug in for right now a $6,000 figure. Obviously, the dealer can look at an individual trade. If they were working with this tool directly, they would put that in there. For our purposes here today, we're just using a ballpark figure, what we think the used value of the car would be at that point in time. And then that drives a number of the calculations below. So the interest collected across that 24 months is showing to be about $6,700. I realize some of you folks would be catching this podcast in an audio format, so we definitely would urge you to go find our YouTube channel, subscribe over there, and catch this on video, because there are a lot of things you're going to see on the screen here that will be easier to identify if you're able to see the video version. So now we get into trade figures, and for our purposes here, what we've done is we've said if we traded this car in, and it has a balance, by the way, a principal balance at that 24-month interval, according to our amortization of right at $9,100. So in this scenario, what we've done is say, let's allow the customer $9,100 in the interest of not having them carry a balance forward to their next account. Okay, so everybody knows how that works. We would, if we had some negative equity, if we're upside down, if we gave the customer the real value in terms of a trade allowance, we would have negative equity carry somewhere. So in this case, we're writing it off internally, and we're allowing the customer that full amount to avoid carrying anything forward. Now, we get into the cash flow side, which this part is pretty straightforward. It's kind of what you'd expect. And the other thing I need to explain for the way the tool is set up, it assumes that everything happens in the same calendar month. So this is really just looking at the same calendar month that the customer traded. Okay, so we liquidate the trade and so on. So now what this says is we would replace the unit that has sold. Right. And if we use the same deal structure, if we say our model is consistent and we have a similar deal structure, then we would be spending about $11,000 to replace the car that they bought. We would have a trade then to liquidate. And I asked our members last night to think about this as though the trade went to the wholesale market. We can talk about what happens if it's recycled, but that's a separate conversation. If we just liquidated that car for cash, wholesale or whatever, then we would be getting $6,000 back into the bank account. And then we would, in this case, I've got it loaded up at 0 down payment from the customer.
There is just a swapping cars.
It's a swap, yeah. Okay. It's a simple swap. It's
same payment, same.
Yeah, bear with me. I know folks are tuning in because our podcast is really around the water and the portfolio, and we're going to get there. You're going to see, as a result of all these calculations, how this illustrates what could be described as water or false equity, phantom equity in the portfolio. Because of these scenarios, it starts to highlight, the problem that comes about is this idea of having, a potential water in the portfolio. So this basically says then the dealer, in order to trade that customer now with 0 down, the dealer would be going cash negative in that calendar month by about $5,500. They would actually feel that in their bank account as a result of that trade. And the result becomes, now this is the part that's debatable, gross profit from the new sale. That part's not debatable. We know if they bought the same kind of deal structure they bought before, that'd be our gross profit. Now we have the internal write-off of the trade, and I'll be reaching out to our CPA friends out there in the industry to confirm whether there are any other entries to the profit and loss report as a result of this trade. The dealers seem to think that the trade that we acquire, the actual value of the trading that comes back in, is going to impact the profit and loss. I'm thinking it doesn't, based on the feedback my own experience. ChatGPT, one expert gave feedback, and so that basically provides. Forgive the phone. We got a phone in the background. We'll try to silence. But so now that's a question. This is the part that I say you can't really hang your hat on the profitability. But if this is correct, and these are the only 2 entries to the P&L, then we would be showing about a $900 negative as a result of that situation, as a result of trading that customer. So sorry, we've got a problem over there. So you get it? Yep. So the result again is going to be a $900 loss as a result of doing the deal at month 24 with no down payment. Okay, so keep in mind I didn't show the rest of the parameters over here, but we're working with a 24% interest rate on this particular deal. Okay, so that obviously drives the balance that the customer owes at the end of that. And now the impact to the balance sheet. The notes receivable are going to go up as a result of the new sale. In this case, $20,000 because we didn't have a down payment. Notes receivable go down by that $9,100 where we're writing off the old trade balance. We acquire the new trade, and again, this assumes the liquidation of that trade. So there would be cash into the bank account as a result of that, which hits the balance sheet. And then the cash account related to, we wrote a check to replace the old, the unit that sold. Okay, so now that says that our bank account impact across, or a balance sheet impact across that time period is going to be a little over $6,000. We now have about $6,000 more in assets. You could say we spent $5,500 to get them, but I think the part that we're looking at next starts to inform the conversation about this water in the portfolio, and also wrapped into the same conversation is, what is the value to us with trading this customer at this particular stage? Okay, so what, if we did that, what could be the benefit? So we started to look at things like this. What is the projected interest on this note? If we choose not to trade, we have about $1,500 of anticipated interest income. All right. If we do trade, what happens? We have a new larger note. Same customer, let's say the customer keeps the same payment. And now, because their balance went back up, our projected earnings from an interest standpoint in the next year would be $3,800. Okay, so this is a difference right there. There's a $2,000 gain as a result of doing that. So to further illustrate the impact of those things, I went a little bit to the next step to say, in this contract, at the terms that we've got loaded, this dealer is collecting about $360 in interest in month one. By the time they get to the end of the first year, they're down to about $285. At the end of 2 years, they're down to about $186. And at the end of 3 years, the contract is almost done. And so we're down to $61 of interest per payment, or per month in this case, a monthly equivalent. So there's a whole lot here, Michelle. There's a lot to think about in that math. And so we're going to move over in a minute to this conversation about water in the portfolio. But I think one quick thing that I don't want to forget to mention, I said it in our V8 meeting last night, and I know dealers recognize this, is when we start to study the difference between profit earnings and interest earnings, say gross profit, markup on the car, versus interest earnings. So interest is not recognized as income until we collect it. So this is important in terms of taxation. When we think about taxation in our business, which can be difficult, right? It can be hard on us in the buy here, pay here space because we're taxed on gross profit that we've not yet collected. That's why you hear the phrase phantom profit, right? We have this profit that we may collect, but we're being taxed on it. So that's why you see the related finance company. Interest income, though, regardless of which company, dealership, RFC, that that income is only realized as the customer makes the payment, and it becomes real income.
Can I ask a quick question on the tax side? Again, this is real time. I don't know if it's going to be a good question. That internal write-off, is that a tax write-off?
Yes, it's a reduction in the profit of the business. So yes, it reduces income in that period. So is that something that we could look at, if you track that out and you're doing that with most of your portfolio, how this shifts your tax liability by doing this? I've worked so hard to create this, and Michelle's got me creating more.
Okay,
sorry. Said, can you create more?
Can I create more? Yeah. Well, I mean, but I do know that that's a big deal for most dealers, is what they're having to pay in taxes.
No, so, I know. Yeah. And she's just recognizing, because she's intelligent, she recognizes the value. You start to visualize, like many of you listening, you start to visualize, what's happening here. And I think for us, again, we look at the 24-month mark for a couple of reasons. We'll try to give you some time to understand why we think that's a significant number in our business. But let me go one step further on this. I've got some additional calculations to really contemplate here. And this was fun last night in our V8 conversation. I'm going to throw the question out for our listeners today. When I show you, let me try to
thanks, Karen, for the comment.
Yeah. So let's hide this for a minute and show what this shows, that across this 24-month period, this dealer has collected $15,576 from this customer, principal, interest, etc. That's, by the way, just P&I. That's not down payment. Okay, so we've collected that much money because the reason I didn't include down payment is because we're calculating against risk here. We're looking at how much of the risk that we have out there how long does it take us to collect that, right? And so a lot of dealers, if they're in a 20 group, they're used to looking at something called months to break out. How many months does it take me to collect out my risk? Okay. So we think about that in this area. It says, okay, 15,576. And I asked dealers first last night to say, when you start collecting money, do you think, because there's really three types of money that we collect here, Michelle. We collect our basis, which is our risk or our cash and deal, right? So in this case, I show that that's $9,436 in this illustration.
I'm going to screen that up a little bit.
So I'm going to go one at a time. So basically what I'm trying to show is that the idea here is that I want to be able to have our dealers think about, do you think in terms of when the money you start to collect from the customer, if you had buckets, like I said, risk, basis, cash and deal over here in bucket number one, you've got gross profit in a bucket and you've got interest earnings in another bucket. Okay, those are basically your three buckets. So I asked the dealers, and the few dealers we waited for feedback on last night, they basically said, yeah, I think about recovering my risk first.
Okay.
So if you apply the money to the risk first, then that says you're going to collect about $9,400, or the $9,400 risk has been collected at the end of 24 months, and we're sitting with positive cash or surplus cash of about $6,000. Okay, we've collected about $6,140 to put in the next bucket. All right. So this is where it gets a little interesting for people to think about, the money that's coming in. I've had this customer on the books for 24 months. I've collected $6,100. I have an extra $6,100 to apply. And we've already collected from that customer $6,700. Okay. So what that tells us is
of interest.
Of interest across that 24-month period. So what that tells us is the $6,100 doesn't even cover the interest bucket. Okay, so it's another way to think about that. We haven't even filled the interest bucket at this stage. Again, we're at 24% interest on this one. So what that means is the amount really that we've collected in terms of gross profit on the original deal is nothing. If we're taking the money we collect from the customer, just P&I, all the cash, and we put it first in risk and we put it next into interest, then we have not yet collected any of that gross profit on this deal at the 24-month mark. So why is that significant? Well, because we're 2 years into the contract, we know that these cars only perform a certain period of time, right? They have a certain shelf life or life expectancy. They have some miles typically when they're financed originally. But I think the other thing that concerns me here is a couple of things. One, we run the risk of paying income tax. We're into 2 full years of taxes filed, right? On this, we've covered 2 tax periods in this situation. So we run the risk of paying gross profit, or paying income tax rather, related to gross profit that we haven't even collected yet, 2 years in, if we apply the math this way. Obviously, when money comes in, you can put it in whichever bucket you want, the dealer can. It's just, I think this is starting to break it down in a way that we can start to think about that and think about lots of considerations. And again, this is a lot of kind of deep math that we're dealing with today, but I think it's really important math for us to contemplate, and it's challenging. We look at a deal, we have a customer who's been a good customer, their car's got a little issue maybe, or they've maybe had a little change in their family situation, whatever, and we're contemplating trading them. We know we want to keep them on the books, right? It's just the question becomes, what is the target outcome here, and what do we want to do in terms of our model, in terms of earnings? So, will it make sense for dealers to trade at 24 months? We're just putting the information in front of people and they can decide for themselves, right? This is what we're doing at V8, is making sure that people know. I'm not able to read the comments from where I'm sitting. So it just basically is saying this, and by the way, this is really just, as a former dealer myself, this is the stuff that always was really challenging to know. And we've confirmed in our 2 V8 conversations around the subject already that it is challenging for dealers to figure out. We've heard dealers say, this is kind of a case by case basis. And I get that. I would say the math is not a case-by-case basis. Because when I hear dealers talk about the case-by-case, that's an underwriting decision about whether they want to finance the customer again. This is not underwriting decision. This is hard math around what the deal structure looks like if you trade the customer. Okay, so it's a different thing. It's not about underwriting. You're going to make a yes or no decision about whether or not you want to trade. But when you trade, we're just saying this will be the mathematical outcome. So again, we've got work to do on the profit and loss side.
So Anna Maria said, you should win an award for your spreadsheets because they're so thorough. And then Ivan, right here.
Yeah.
And then Ivan, Koretev? Ivan, sorry. Probably proceeds from the car sale, the $6,000 need to be applied to P&I.
Okay. So he says probably. We're going to find out. We're going to ask the CPAs, and so we'll find out, because I know it hits the balance sheet, right? We know it hits the balance sheet, but we're going to ask the CPAs about the impact on the P&L, and so we'll come back with that information from. We'll use our fractional CFO, Paul, says we'll use a 3 expert rule. We'll go out and get 3 experts to give an opinion on that. And in the GAAP accounting, they probably all have the same answer. So we'll find out. We don't have to decide for ourselves. But we'll go back to that. So the other part I wanted to really illustrate, and what this tool provides us an opportunity to do, because as we work through the modeling, one of the things that became glaringly evident was the impact of APR in particular. And I think for today, that's where we'll stop, Michelle. We'll look at APR and just show the difference. And I would say across our V8 groups, we have dealers at 18%, I think is about the lowest. Now, that's not true. We've got some people doing tiered stuff that's down in the 15, 16% range. But I think for our illustration here today, what I want to show is the difference between 18% interest and 28% interest. We got dealers in our V8 circle that are in that 28, 30% interest range. And so I think what this does, this tool allows us to use the same deal structure. This is the same selling price of car. We're not going to change the payment. We're not going to change anything about that. We're just going to change just the APR. So let's drop back to 18%. And what I want you to look at is over here on the balance that the customer owes principal at the end of 24 months. Let's look at that number at 18%. It's showing that the customer at this stage, 2 years in, would owe about $7,000 on that note at 18%. So let me just let folks think about that for a minute and say, so we can also see that now the interest earned across that period is less. It's $4,600, right? We reduced the interest rate, so it stands to reason we're going to have less. We're also going to have a $7,000 payoff instead. So we can have a quick look at the cash flow is $5,500. The balance sheet is now going up $8,000 as a result of this same trade with no down payment. So that's interesting. I didn't really contemplate the impact of that part. But if you think about, again, same car, we're trading the same car in the same condition. The customer paid the same payment for 24 months. They put the same down payment originally. This car cost us the same. Only thing we changed was the APR, right? So now the customer owes $7,000 at that stage of their contract. And now if we just go back and move that interest to 28%, now the customer owes about 10.6. Okay, so this is important. This is really important math. I think this is an important thing for us to contemplate. And again, I know that, the lenders out there in this space, they've been looking at this math for a time. I just haven't really seen them share this kind of information with us. And I'm sure that as they make their own underwriting decisions and stepping in and providing financing for dealers, they're analyzing this kind of stuff and they see that. But when we talk about this idea of having water in the portfolio, I think it's really a way to, because I wasn't the one who used that phrase. One of our V8 members, who's a former banker, was able to say, after seeing this same math, said, it just kind of looks like you have water in the portfolio. So what does that mean? Well, the balance of the account went from 7,000 to 10.6, same customer, same car, same payment. So if you think about 100 of these contracts, or just multiply it, think about 2 dealers financing the same customer, same kind of car, same payment. Underwriting's the same, right? So, you could say one dealer's got a $7 million portfolio and the other's got a $10.6 million portfolio. And I'm not here today to make the case for one or the other. I'm just saying they're very different. They're very different.
They're very different, and they're taxed very differently too.
They're taxed differently. So we talked about, you could make the case here that this dealer's still sitting on these assets, and this dealer has collected more interest. They've collected more interest, and we said that that interest is only shown as income as they collect it. I think the question becomes, isn't it logical to conclude that this dealer would probably face more severity in their charge-offs? Again, let's imagine a scenario where this customer charges off at month number 30, okay? Mm-hmm. Well, obviously, again, same car, same customer, this dealer is going to have higher severity, which, folks who aren't familiar, in charge-offs, they look at severity in terms of dollars and then frequency in terms of count or number of accounts that have charged off relative to sales. And so this is something that we have to be mindful of, because clearly this dealer is going to have, in the event of a charge-off, customer has the same life event that we know our customers have, the car ends up in a repo and charge-off. The cash value of the repo should be the same, right? The repo, what we recover in cash should be the same, but clearly the dealer who's got the higher APR is going to have a higher principal balance, and the severity of their charge-offs is going to be higher.
Okay.
I'm not saying that has anything to do with what we've been looking at separately in terms of increases in charge-offs recently, but this math is just math. I mean, you can run your own amortization, run your own calculations. This was built on multiple amortizations at the beginning, but it's like, I think this is something that we don't spend enough time talking about in our business, and certainly in VA, we are breaking that down in some depth. And now what it does is it allows us to continue the conversation, add other layers like the one that you referred to, and then also allow dealers to form a more intelligent policy around trading, right? That will, because I think the part we don't know is, if we don't trade this customer at 24 months, we do know that customers do start to lose interest in the car they're driving, right? They see something shiny, they like the idea of trading, they would like something new. So we know there's the desire factor to trade. We also know that there's a light at the end of the tunnel factor when a consumer starts to see that they're getting their balance down and they want to own it. Dealers said in our meeting last night that once the customer gets down to where they pay it off and they get the idea of being without a car payment, they tend to not want to buy another one. They want to kind of experience what it's like to not have a car payment for a while, which is understandable. And I'm not advocating for one or the other. I'm just saying it's a real thing. Customers have that. And now all of this information just helps dealers to make a judgment. And I think it's fascinating from a lender perspective, bulk buyer perspective. Two dealers, same customer, same collateral, very different balances in their portfolio because of the APR. We know that those folks have analysts and they recognize that and see the difference. I just think this is what's beautiful about our buy here, pay here business. Dealers have the flexibility to create their own business model, deal structure, whatever works for them. I think part of the reason, and again, there are many, we don't need to go into all of them today, but part of the reason that I like for dealers to study the 24-month mark is, I think if we can understand the math of what it looks like to trade the customer roughly every 2 years, then we can adjust our model accordingly because of these numbers down at the bottom that say, we're collecting a certain amount of risk and a certain amount of interest, and the rest is gross profit. And how that balanced out is up to us. Now, it is worth mentioning that even though we haven't collected any of that gross profit, I didn't say it, I shared it last night. So obviously we need that gross profit in there. We need some gross profit in there because obviously that runs the price up to a point that does drive the interest, the account balance drives the interest earnings. So it's not that you wouldn't have any gross in the deal. If you did, you'd have a lot less interest earnings. So this is all part of the kind of the big math that we've been working on of late. And again, we're going to continue. We're going to use this to help dealers create a template that they can create their own policy around trading at various intervals. But I think for today, it was like I say, it's not a debatable kind of conversation. It's like, it's just math. I think we're going to get the opinions from the CPAs on the P&L entries, and we'll bring that back to everybody once we have something definitive from them. But I would say for us, we're just trying to put information in front of dealers so they can make these decisions for themselves. And this is the work of White Hat Way. This is what we are, in addition to all the work that we talk about with the intangibles and customer relations and all these kind of things. White Hat Way is also working to bring better information to dealers, and we invite others to come be part of this conversation so that we can collect as much good information and put in front of dealers, because they have a tough job. It's gotten tougher in the last couple of years.
Yeah.
So it's like they have a difficult job. They have difficult decisions to make. And I know as a business manager and as a former dealer, the more information, the best information I have in front of me helps me make the best decisions. It's simple as that.
Absolutely.
Yeah.
And again, if there's anything we can help with, please call or text 903-816-0216.
Yeah.
Again, this tool will only be released to V8 members.
Mm-hmm.
So, if you have an interest in joining a V8 group, go ahead and call or text at that number as well.
Please quit postponing that decision about a V8 dealer group. It's time to get you in there. These folks are having some really rich, uncommon conversations, and we want you all to be a part of it. So please get in there.
All right. Anything else you want to add?
I think we should let folks get back to their Friday.
So I'm going to bring us back here, and thank you. Let me bring some music up too.
Yeah, we didn't announce the fact that we totally missed a Friday or a Wednesday slot this week, and so we had some other matters related to my mother's probate, and so it took us kind of on another path, and so we just never got back around to recording one. So we'll
we have this topic queued because we've been doing some research on something, and it's pretty darn rich.
So just letting folks know, White Hat Wednesday hasn't gone away. It just had a little gap last Wednesday. We'll be back next Wednesday.
Absolutely. Thank you so much, everyone, for joining. We appreciate you being a part of the show and taking some time during your day to be a part of it. All right, everybody, have a great rest of your day, and we will see you on Wednesday. Thanks again so much for joining.